Hi friends, this is Sumit from Sumit Revaskar Trades. So today we will discuss about derivatives. So what are derivatives? So derivatives are instruments whose value is derived from underlying assets. That means the value of the derivative depends on some other underlying asset, that may be an equity or something else. So it doesn't have its own value, it derives from some other element. So these are derivatives. In derivatives, we use derivatives for hedging. Now hedging is used as a tool for risk management, and we will discuss it in detail in some another video. The second most important is margin traders. So in derivatives we get huge positions. We can take huge positions at a lower cost or a lower margin. So margin traders use derivatives for trading, and speculators. So speculators are basically the one who are just in a trade for the profit. So these three are the major reasons people trade derivatives. So derivatives are of two types, that are futures and options, and most important thing is that derivatives are traded in lot sizes. So even if you want to buy a future or buy an option, each and every script will have its own certain lot size that you have to buy. So this is basically about the derivatives. Now we will discuss about futures. So future are the contracts which has a fixed price and has a fixed time limit. So suppose if there is a buyer and there is a seller and there is fluctuation between the prices. So the buyer and the seller will go into a contract that the buyer will buy the product at a certain fixed price from the seller for a certain period of time. So this can be said as a futures contract. So in this way, the total business, the complete business is very well secured. The buyer is also having a fixed price for a certain period of time. Also, seller will get a fixed amount for a certain period of time. So this is how basically futures work. But for our trading, we are more focused on the margin which futures provide us. So let's take an example. So we are having a segment. So it is an equity segment and future segment. We will do a comparison. So in equity segment, if I want to buy 1,000 shares at a value of 1,000 rupees each share, so I will have to provide 100% margin at the buying period itself. So now, so I will have to have one 10 lakh rupees in my account to buy 1,000 shares of rupees 1,000. But in case of future, if the current market price of is 1,000 and quantity of the share is also 1,000, but the margin required from for the script is 25%. By the way, the margins are different for different scripts. So for this example, if margin is 25%, then we only have to have 2,50,000 rupees in our account to buy the futures contract. So as this case says, in equity we would have required 10 lakh rupees in our account, but in futures we can have that much of big position, 10 lakh rupees position, with only 2,50,000 rupees only. So that is the main part for a trader which is important, that by futures we can take huge positions at relatively very low cost. So we will take an example of profit and loss. So I am purchasing 1,000 quantity. So segment wise, if I buy equity, so I am my investment becomes 10 lakh rupees for 1,000 quantity at 1,000 rupees. Now if I have a 10 rupees profit, so the profit is 10 into 1,000, that is 10,000 rupees profit, that is equivalent to 1% of my total account balance. But if I lose 10 rupees and that is 10,000 rupees, then my loss is also 1%, which is relatively very low. But in case of futures, my investment is 2.5 lakh rupees, and if there is a difference of 10 rupees, I am gaining 10,000 rupees for that investment, for the price difference, and my profit gain is also 4%, which is very nice. But in case of loss of 10 points, I am losing 10,000 rupees, that is equivalent to 4% of my total account value. So as shown in this example, the profits as well as losses in futures get magnified, which would have not been the case in terms of equity. So that's why derivatives are very much risky and we should trade them in very caution. So now we will discuss about options. So options, we have two things. There are call options and put options, and also we have a strike price. So basically, strike price is the certain price at which we enter the contract. So I can say that options is kind of betting. If price crosses certain point, then we are into profit. If price doesn't cross that, so we are into loss. It's kind of typical betting. I should not call it as a betting, but then it is what it is. So we'll take an example for a company. If current market price is 1000 rupees, we have call option, we have put option, and we have strike price. So strike price is given like this. In any script you can see with your check with your broker. So the strike prices are given in numbers, and then calls and puts are traded. So as shown in this example, you can see the all the call options that are under the strike price of 1000 rupees have higher value than those which are higher than the 1000 rupees, that is current market price. And in case of put options, all the values that put option has a greater value when the above the current market price for the strike price, which has current market price which are above current market price, and the price, the value goes less and less when the put strike price is less than current market price. So why this thing happens? We have a simple concept: in the money, at the money, and out of the money options. So at the money options are the options which are at currently trading at the current market price. So if the current market price is 1000 and strike price is 1000, so 1000 is at the money. So if the price of the call option is strike price of the call option is less than the current market price, then it is called as in the money. And if the strike of the call option is higher than the current market price, then it is called as out of the money. Also, in case of put option, if the value of the strike price is higher than the current market price, then it is called as in the money. And if the value or the strike price is the less and than the current market price, then it is called as out of the money. So this is the basic funda in which the options trades, but there are complexities. Now we will take an example about a company with current market price at 1000 rupees, and if we buy a call option at 1000 at 10 rupees, and we sell at maybe plus 5 profit and or plus minus 5 rupees profit or loss. So as per segment, we are discussing in equity, we would have spent 10 lakh rupees and then we would have gained 1% profit or 1% loss. In case of futures, we have already discussed at 2.5 lakh rupees investment, we would have earned 4% or lost 4%. But in case of options, the amount required to buy that option is only 10,000 rupees. So at 10,000 rupees, you have bought that option. Now if you get plus 5 or minus 5 as a profit, so difference is 5. So you will get 5,000, I mean 50% on that investment. Or if you get loss in that trade, then you are losing 50% of the account balance. So but one more thing we need to see is that in this option trade, we are only having 10,000 rupees as the balance. So even if our complete 10,000 rupees gets wiped out, so still it is a very decent loss as compared to future. If in future the loss is huge or the drawdown is huge, the value of loss is very high. Even in case of equity, if drawdown is on the higher side, then the losses are also high. But in case of options, if you are buying an option, then your losses are limited to the value of the option or the buy price of that option multiplied by lot size. So in terms of options buying, you are very much safe in terms of losses. But if you are selling the options, then you are open to the huge losses. So this is the basic comparison between equity, future and options. So obviously you can see in lesser amount of investment you can grow your account by maybe 40-50% in few trades, or maybe 10-20% on an average on one trade. So it's a very great opportunity for those who are having very less account balance, and they can grow their account multifold using options. Plus, there is a catch that options are and futures too are very complex products and very risky products. In terms of options, we have things which we know as option Greeks, that are delta, theta, vega, gamma. Your options price, your volatility, and your profit and loss, each and everything will depend upon the option Greeks. So these are very in-depth topics. So option Greeks we will cover in other videos. So basically in this video we are just given an overview about the trading benefits in futures and options over equity. So if you have liked this video, then please click on the like button. If you want some content to be created according to your requirement or something topic you need to be covered, then please put it in the comment. And if you liked this video, please subscribe the channel and do share with the friends. Till then, bye.